Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for September 14th, 2020. Please see our disclaimer for important information. As we start off the Charts of the Week this week, we'll revisit our familiar COVID tracking chart here that just it's going to look very similar to the last several weeks. The good news is that both our 7-day moving averages for daily new positive cases as well as daily new deaths are continuing to trend down. That's very, very positive. We want to see that continue. We first showed this slide to you about a month ago, and this just represents the drop from the peak occupancy levels for hospitals dealing with COVID-19 patients. And the third from the right, or excuse me, the third from the left is Texas. And when we first showed this to you about a month ago, that number was down about 50%. So it's good to see here that we're making continued progress, and now that we're down about 67% from the peak. So we continue to trend down, kind of like the national moving average statistics that you see in the prior slide. I mean, things are generally getting better, but having said that, I think obviously we're still on watch for what could happen this fall. We know flu season will be upon us fairly soon when things cool off, and viruses tend to be a little bit more active when the weather is cooler. So obviously we want to continue to monitor that very closely. This is something I thought was quite interesting. If you look in basically new COVID-19 cases through September 9th, you can see in that orange or amber line that we've had that continued downtrend that we've been talking about fairly consistently. But you look in college towns and you can see a rather dramatic spike as college campuses are getting underway, and you've been hearing stories of colleges having to suspend or reprimand students that were gathering in large groups and parties and what have you. So just interesting to see the difference here in college towns. Now we get into some economic data, and this is essentially a weekly economic index that's put together by the New York Fed, and it's a national index. And so what it's doing is it's giving us a window into kind of overall economic activity, which comprises a number of different things: consumer, corporate, sentiment, so on and so forth. And so what we found here is that we continue to expand. And we're seeing a lot of mixed messages right now. Obviously, July was a little bit of a rough month from a data standpoint because we had some resurgence in cases, and as we've talked about ad nauseum here, a lot of jurisdictions kind of backtracked on some of the reopenings and things like that. So we saw a little bit of a dip, but good news is that we're, at least from this measure, that we're continuing to see an uptrend, even though we're far below where we have been in the past. Now we've got some inflation data, a little bit of busyness on this page here, but essentially, the key takeaways, you look at the picture on the left, is that we have inflation that's expectations are going up. And this is inflation as measured by the 5-year treasury rates and measured against the 5-year TIPS yield, which is the Treasury and Inflation Protected Security. So if you take the difference between those two, you get what the implied inflation rate is. And it's a very good indicator. And so you don't have to know the math in that, just know that this is a really good proxy for what the embedded inflation expectation is in the Treasury market. And so as you can see here, we continue to trend up. Right now we're above that 2% line that the Fed has kind of marked as its target. We're running a little bit hotter now on an expectation basis. And you can see if you track back to 2019, getting past April-ish of 2019, I mean, we're about at that same level now. And obviously, we've had higher inflation expectations if you go back to 2018, so on and so forth. What this is having a bearing on is the negative real rates. We know that interest rates are going to stay low for a long time. But if you basically take the nominal low interest rates that we have now and subtract the inflation, which we see here is going up, then what that does is it makes negative rates, negative real rates, even more negative. And that has implications for gold, it has implications for the US dollar, certainly has implications for the stock market. On those three fronts, you could argue one, it's going to support a devaluation of your currency. It's going to drive more money into gold, and it's going to drive more money into other, call it risky, assets, i.e. the stock market. On the right now, you see, the difference in inflation that we're seeing now distributed between goods and services. And so what we're seeing now is clearly more inflation embedded on the service side than on goods. And we've had a continued kind of almost a deflationary, because we've got more technology embedded in our goods sector, and technology is adding productivity, which is keeping inflation low. But we're, as you can see here on the service line, we're clearly having more inflationary pressure there. This is a measure of consumer sentiment, kind of defined two different ways. On the left, we have the Refinitiv USA Consumer Sentiment Index. This is, basically Refinitiv is the old Thomson Reuters, if you will. And then on the right, you've got the Bloomberg Weekly Consumer Comfort Index, and they both tell similar things. And as you can see here, the one on the left is drafted over a number of years. You can see that obviously we had a very consistent methodical rise in sentiment, and then that was shattered when we had the pandemic. But even with what happened in July, we could see that August we perked back up. We're still well below original levels, and that carries over on the right side too. That we've seen that dip. We're recovering in terms of sentiment. We still have a long way to go, but positive developments in both of these with regard to consumer sentiment. This is another interesting chart that I pulled out of what it speaks to inflation, and the many conundrums that we've had to deal with amidst this pandemic. One of which has been the whole labor issue and the notion that you have school as an institutionalized form of daycare, because it allows kids at school, allows dual working parents, both to be out in the workforce. And when you have kids at home, that creates a huge problem. But here we've got the issue that we've seen a lot more inflation in child care, nursery school. So this is creating this kind of new conundrum here. So you've got these price pressures that people are having to deal with when they go to the workforce and they have to send their kids to child care, nursery school, things like that. And so with the inflation rate, what that kind of implies is that now that people have a choice to stay at home, that they can combat this type of a problem and this type of rise in consumer prices simply by staying home as opposed to going to the workforce. But anyway, not a tectonic data point here, but just something I thought was really interesting and worth sharing. This is small business optimism, and we've talked a lot about small businesses over the last several months, and there's, I think some conflicting information out there, but it's clear that there are a lot of small businesses that are struggling. Now, this is kind of almost disingenuous in the sense that it's rebounded off of such a huge low that it's kind of meandering a little bit over the last several months below where it was before. But you can see that optimism for several years was relatively high, and so we're actually sitting at a point, at least on this index, that that we haven't seen, notwithstanding the last several years, but we haven't seen for a while. And so I think it's kind of interesting that we have some kind of green shoots in the small business sector, but we still have a lot of small businesses that we know are struggling, and hiring is down, and we've got a lot of small businesses that are at risk of shutting permanently, as we've talked about over these many weeks of the Charts of the Week program. Small business Capex plans. I think good news here, again, kind of fitting in this theme that we've rebounded off the trough. Where do we go from here? Obviously, we're not back up to levels that we've seen in several years, and Capex, it means that kind of implies the confidence that business owners have in reinvesting in expansion, reinvesting in productivity, and reinvesting in technology and things like that. So we have improved. We're higher than we were, say half a decade ago, but we still need to continue to show some progress here. This is a measure from Alignable for recovery concerns, and this is essentially a sampling of small business owners, 5,557 to be exact. But if the data points kind of most of these don't change a whole lot necessarily, but some do. But you can clearly see that financial reserves running out is a major concern. Government reclosing business due to coronavirus, and again, as we sit here in September, not knowing if the virus is going to reemerge. I mean, that's obviously on the minds of business owners that can ill afford to have any kind of additional shutdown, especially at a time where our friends in Washington are having great difficulty even coming to some compromise on an interim fiscal stimulus package. Customers afraid to return. That's a big fear for a lot of retail firms, that retail business owners that I talk to, that they're actually doing perhaps maybe a little worse now, even with some of these reopenings, than they were when the business was closed and they were selling everything online. And then obviously you've got some other things there, but really the main change into August is being, for May, if you look at customers being afraid to return, that's not as big of a concern in August as it was in May, but it's still, you've got 1 in 5 business owners that have stated that as a pretty serious concern. So in the slide, or I guess the 2 charts here, this just lists job postings, and this is kind of a new or kind of a refreshed indictment on what's going on in small business. That obviously in the 2020 on the left, you can see that big trough at the peak of the pandemic and the closures. We have battled back, so this kind of goes to some of that small business data that we just looked at several slides ago. That's good news. There's still about a 19-20% gap between this year and where we were last year, which in and of itself, in terms of job postings alone, is still below where we were in 2018. So good news here, if there is a takeaway, is that we're recovering at a faster pace. Again, kind of almost this Nike swoosh type recovery, but again, we still have some ways to go. And on the right, we have job openings. Again, this is positive. We're seeing job openings, probably not necessarily in the areas that we need to see them. Obviously, a lot of the jobs that were lost were low paying service jobs that were directly impacted when there were shutdowns and things like that. But nevertheless, it's good to see openings move in the right direction. We'll talk for 2 slides here about housing. And we see here the 30-year mortgage rate down to 2.86, and it's kind of been holding down here. It's obviously a great time if you have good credit and you can refinance. It's a good time to do that, because we haven't seen rates this low in a long while. And so again, very positive for the housing market. It's an incentive for people to refinance. Now we take that same 30-year fixed rate and we plot it against refinancings. So this is taking, putting faith into action. You can believe me when I tell you that low interest rates are inspiring people to refinance their mortgages. But here you can actually see the data. And this has actually been fairly consistent. If you look over several months, frankly, that as rates continue to go down, we continue to see more refinance candidates. We see a lot of cash outs. We see people taking money out and doing home improvements and building pools and things like that. And so, and, you've got a lot of families and households reinvesting in frankly, their largest asset. We'll talk about the stock market for a few minutes. Here's your S&P 500 chart. We have tested what is in that red line is the 50-day moving average. So we tested it before in July. That's when we had the rise in COVID-19 cases. Here in September, what we've really had is just kind of a retracing, if you will, of some of the gains that we've seen in this narrow leadership of technology stocks. And again, we held the 50-day moving average back in July, and it'll be important to see that we can do that again. Again, this is a little bit more of a technical analysis, if you will, but generally speaking, if you break through that 50-day moving average, then it's more likely than not that you continue to fall for a little bit further. So we want to make sure that hopefully we can maintain that 50-day moving average. This is a breakdown in returns, I call excess returns by factor. And really, I don't want you to get too wrapped up in the math, just other than, to kind of, allow me to highlight where, some of the action's been in the market. Now, you've heard me talk about the difference in returns between growth, momentum versus value, and that's very evident in the first two lines. So value is tremendously underperformed growth. Growth has actually added value. Momentum has added value. Dividend yield, ironically, we saw a lot of companies at the end of the first quarter during the heat of the pandemic make dividend cut announcements or dividend suspensions and things like that. Even though over a long period of time, you can make a clear argument that dividends have accounted for somewhere close to 40% of market returns overall, that here yield has clearly not been attractive, even though with declining interest rates, the relative yield of the equity market is much better. You can make the argument that the dividend yield of the stock market right now is tremendously better, by almost 2x what you could get in a comparable 10-year treasury right now. Size has not been particularly important here, but quality has, and this kind of goes to the point that I've been making in some of these comments about what we're doing in portfolios, that we're actually improving the quality of the portfolio, where lesser quality companies are lagging behind, because these are the type of firms that don't have the same financial wherewithal, the same access to capital and banking resources and liquidity and those types of things. And also, finally here, the volatility factor has been less important when we've had a period of higher volatility. It's a little interesting. Here is the value versus growth proposition illustrated. Really kind of, you can't get a better representation of this. So this is essentially value versus growth over 10-year annualized returns. Now, what's clear in this is you see a lot more dark blue than you do red. And what that tells you is that you tend to have better performance in value over longer term horizons. And again, each data point here represents a 10-year annualized return. So these are rolling 10-year returns. And so outside of the dot-com bubble back at the end of last century, in which value greatly underperformed stocks, and back then we were talking about like a lot of companies like pets.com that was barely past having even a business plan and was getting outrageous multiples. And so value stocks were greatly unloved then, but it's interesting that there are more unloved now than they were back then, which is just phenomenal to think about. And what that really speaks to is the power of the FANG stocks, the power of those really mega cap technology stocks that have taken on tremendous investment here. And but just keep in mind that that value does tend to outperform over longer periods of time. And I think we'll kind of conclude with a couple of kind of general interest slides that I thought were really interesting in the daily shots. Here's a representation of the share of renters with missed rent payments, and that number is about 20%. Interesting, perhaps that maybe that number, as you can see, is scrolling from left to right, is on balance maybe perking up a little bit. Essentially 1 in 5 renters have missed payments, and so this has second derivative impacts onto landlords and investment companies that own income-oriented real estate, where you've got an increase in delinquencies, an increase in non-payments, and things like that. And that would obviously impact returns on those types of investments as we go forward. And I don't think that this is a phenomenon that's going to play itself out when we get a vaccine. I think this is going to continue to play out even longer than that. And as we kind of near the end of this package here, I just wanted to something that kind of tugged on my heart a little bit. And this is the share of households that sometimes or often go hungry, put together by Northwestern University study. This had, I guess, some input from census data and things like that. But what it shows is the impact of the pandemic on households that even sometimes go hungry, and especially households with children. And it's just a really compelling chart here that that says that in a kind of a normal environment, if you will, that you have roughly 5% of the population that's hungry. Considering the wealth of this nation, considering the status in the world, and really the wealth per capita of this country, that we still have 5% on a normalized basis that are sometimes or often going hungry. But that number having shot up to 10 to really almost 15%, depending on what your cohort is, here during the pandemic, is actually pretty compelling. And I can speak to that personally just by the volunteer work that I do at the food bank, and those tremendously long lines that we see every week as people line up to get handouts and things like that. So again, we're all in it together. I kind of offer this as just kind of a brief thought on the community, because it's real data which represents kind of a real problem. Well, there you go for this week. And always welcome your thoughts and opinions and feedback at the information you see here. I hope you stay safe and hope you have a wonderful week, and look forward to seeing you again very, very soon.